Welcome back to the Deep Dive. Today we're digging into the second quarter fiscal 2026 results for Conagra Brands.
And this one's a really interesting story. You have two completely different narratives.
Right. On the one hand, you have management painting this picture of building momentum despite a noisy quarter.
But on the other hand, you have the market, which heard that and just slammed the sell button. The stock dropped, and on really heavy volume.
So that's our mission today. We need to cut through all that noise. You've got the huge non-cash charges, the timing shifts, the reaffirmed guidance.
And we need to figure out if this H2 inflection management is so confident about is real, or if investors are right to be, well, skeptical.
Let's start with those headline results because they really do show that dual reality you mentioned.
You have to. You just can't ignore the GAAP result. It was painful. GAAP diluted EPS was a loss of negative $1.39.
A huge loss. But it's important to stress that wasn't an operational loss, was it?
No, not at all. That entire number was driven by this massive $968 million non-cash goodwill and brand impairment charge.
It's basically an admission, right? An on-paper admission that past acquisitions were just valued too high.
Exactly. It's a structural reset.
Yeah.
But if you strip all that out, the adjusted number tells a slightly different story.
A better one.
Marginally. Adjusted EPS came in at 45 cents, which actually did beat the consensus estimate of about 44 cents. So operationally, they met the target.
Okay, and what about the top line?
Net sales landed at around $3 billion. That was a decline of about 6.8% year over year.
Which was more or less in line with what the street was expecting.
Right, no huge surprises there. But the real issue, the thing the market seized on, was the margin picture.
It looked pretty ugly.
Gross margin compression was significant. It fell down to 23.4%. That's a drop of 313 basis points.
Wow. Over 3 full percentage points of margin just gone.
Gone. And it just makes that adjusted EPS beat look, well, it looks expensive. The market sees that and thinks they're just buying volume with promotions and sacrificing profitability.
So management must have had a strong defense for all this. They called Q2 noisy.
That was the word of the day.
Yeah.
And their main argument was all about timing, specifically retailer inventory timing.
What does that mean?
They estimated a full 100 basis points of a sales headwind because retailers slow down their orders right near the end of the quarter.
And they shifted promotions into Q3.
Exactly, especially in their frozen category. Management was quick to point out that those shipments started showing up in December as proof it was just a timing issue.
Investors are always a little suspicious of the timing excuse, though.
They are. It can sometimes mask real demand problems. They also pointed to the macro environment.
Like what?
The S&P payment pause, for one. That directly impacts their core value-oriented consumer.
And then there was the weather defense, which I found a little strange.
It was very specific. The CEO said it was the first October in 10 years without a hurricane hitting the continental U.S., which apparently hurt canned goods sales.
Right. And a slow start to winter hurt sales of other staples.
It's a lot of small things that they say added up.
Yeah.
But investors can hear that and just think it's a list of excuses for soft execution.
Okay, let's pivot to the balance sheet. This seems to be their number one priority.
Deleveraging. It's all about deleveraging. Net debt is high, about $7.6 billion.
Which puts their net leverage at what?
3.83 times. And their long-term goal, the number they repeat over and over, is 3.0.
But the cash flow in the first half was really concerning.
It was. Free cash flow was only about $113 million. That's a $426 million drop from last year.
Which is a massive decline. And their reasoning.
They're saying it's a seasonal working capital build. Basically, they're stocking up inventory for a really big promotional push in the second half of the year.
So they're betting heavily that the demand will show up. That's a big risk.
A very big risk. If that demand doesn't materialize, they could be looking at write-downs. It requires a real leap of faith from investors.
Let's talk about their strategy for making that happen. They call it a tailored portfolio, or the barbell approach.
Right. It's a classic CPG strategy, really.
Oh.
On one side of the barbell, you have your growth engines, frozen, and snacks.
And they're investing margin through promotions to drive volume.
Exactly. And on the other side, you have the cash cows, they're staples brands. They're taking price to maximize cash flow.
So using the old brands to fund the growth in the new ones.
Pretty much. And they did present some data to show it's working, at least in frozen.
What did that show?
They said 90% of the frozen portfolio held or gained volume share, but on a 2-year basis.
The 2-year basis is key. They're trying to smooth out the big pandemic comps.
Right. It's more of a stabilization story than a growth story right now. But the snacks segment, that was a genuine bright spot.
A real win.
Absolutely. It significantly outperformed the category. Their protein products like Slim Jim and Fatty posted 5% volume growth.
Which is huge in this environment. Slim Jim probably benefited from gas prices coming down, more traffic in convenience stores.
No doubt. And they're pushing a lot of innovation there, too.
I saw the list. You've got things like Banquet Mega Breakfast Bowls, the new Slim Jim chicken sticks with Buffalo Wild Wings.
The Dolly Parton frozen meals.
And my personal favorite, Vlasic Spicy Pickleballs.
You can't make that up. But it shows they're trying to hit multiple consumer trends at once, from value to protein to, well, novelty.
Okay, let's talk operational levers. They need execution to be perfect for this H2 story to work.
And they claim it is. They cited record service levels, around 99%, and about 5% productivity in the first half.
They're trying to position the supply chain as a strength.
Definitely. But the big long-term story they introduced was this thing called Project Catalyst.
Project Catalyst.
Yep.
Sounds ambitious.
It is. It's a multi-year effort to use AI, data, and new tech to completely redesign their processes.
The CEO had that great line about CPG processes being heavily manual for the better part of a century.
Exactly. Catalyst is supposed to change all that. But the catch is, we don't get specific value targets or details until calendar 2026.
And that's the problem. The market has a margin problem today, not in 2026.
Precisely. You can't ask investors to wait 2 years for an AI program to fix a 300 basis point drop in gross margin.
Which brings us back to the guidance. They actually reaffirmed their full year numbers.
They did. Organic net sales of -1% to +1% and adjusted EPS of 170 to 185.
That feels like a high bar for the second half.
It's an incredibly high bar, especially because there was a big catch.
Right, the Arden Mills JV.
They cut the expected earnings from that venture from $200 million down to about $170 million.
So that's a $30 million hole they have to fill? About 5 cents of EPS.
And they claim they can do it, that the operating momentum and productivity will more than cover that shortfall.
So they're trading a reliable contribution from the JV for more risk in their own operations.
It definitely increases the execution risk. It makes the efficiency of all those H2 promotions that much more critical.
You can see why the market is skeptical. I mean, just look at the stock performance.
It tells the whole story. The stock is down, about 33, 34% over the last year?
Well, the Staples ETF, the XLP, is basically flat.
That gap says it all. The story has shifted. It's not about reshaping the portfolio anymore. It's a prove-it story now. And investors are demanding proof before they buy back in.
Exactly. All right, that brings us to our final segment. This is not financial advice, where we pitch an outrageous but plausible trade idea.
And the setup here is pretty compelling. You have this company burdened by debt and legacy brands.
But it also has these gem assets, right? Slim Jim, Healthy Choice, high growth, on-trend brands.
And management is laser focused on one thing, hitting that 3.0 times leverage target.
So here's the pitch. The trade is the 3.0x leverage trigger along.
Okay, I'm listening.
You're not buying Conagra for the H2 turnaround. The market has already priced that for failure. You are betting it for the structural change that will happen the moment they hit that deleveraging target.
So what's the trigger? What happens at 3.0x?
The thesis is this. Once that debt target is hit, which should be sometime after fiscal 26, the entire corporate mandate shifts from survival to maximizing shareholder value.
The activists start circling.
Or management preempts them. We anticipate a push to spin off the high-growth snacks division. Think Slim Jim, Duke's, all of it, as a separate, publicly traded company.
And the value unlock there would be substantial.
Immense. A pure-play snacks company could trade at 5 times EBITDA or more like its peers. And Project Catalyst is key here because it makes the remaining Staples company, the stub, more efficient and profitable. So the spin is a win-win.
So the 3.0x leverage is the non-negotiable trigger for the whole thesis.
That's the trade. You buy it now and you wait for the balance sheet to force their hand.
A fascinating structural play. It requires patience, though.
A lot of patience. So to recap the quarter, the tension is clear. Operationally, it was, okay. An adjusted EPS beat. But structurally, it was challenged.
The massive impairment, the margin pressure, the whole H2 recovery story hinges on timing and promotions working perfectly. That's just a really high-risk bet.
Which leaves us with the final thought. The CEO said CPG has been a manual business for a century. We're looking at a 23.4% gross margin today.
And historically, this company has seen margins in the high 20s, 28% plus.
So the question for you to think about is, if Project Catalyst is real, if AI can truly transform this century-old business model, how quickly could that unlock real margin expansion and close that gap?
That is the billion-dollar question that the market's going to be debating for the next 2 years.
Indeed.
And of course, a reminder that nothing on this show should be taken as financial advice. We're here to analyze the data and the narrative for you.
Please do your own research and due diligence. Thanks for joining us for the deep dive.
We'll see you next time.